I am not suggesting that anybody have 100% of their net worth in gold or SpaceX.
The gold price now sitting at $4,200.
The future is a set of probabilities. There's no certainty whatsoever.
Are you adding more to your savings now that gold has fallen to
I
$4,000?
I am. I'm a systematic saver in gold, and I'm not particularly price sensitive. The only thing that causes me to sell my gold are opportunities that I find dramatically more compelling. The last time I sold gold was in 2009.
What is your criteria for adding to your gold holdings? You're not price sensitive, so
Added liquidity.
oh, okay.
People are concerned about the possibility of a credit collapse and a recessionary circumstance derailing inflation. That most of those fears are misguided.
The GDX peaked around the same time gold peaked earlier this year. It's fallen about 37%.
I would suggest that the recent softness in the gold price has to do with three factors. The most important of which is one must look at both the numerator and the denominator in any mathematical equation. I save, David, as I think you know, mostly in gold. I maintain liquidity in Canadian dollars and occasionally, in US dollars and occasionally in Canadian dollars. And when I look at the basket of goods and services that I acquire today, in the context of my savings, in the context of gold, I'm struck by how cheap real estate is. I'm struck by how cheap healthcare is. I'm struck by how cheap food is. I'm struck by how cheap energy is. When I started saving in gold, gold was $250 or $260 an ounce. And if I measure the S&P performance since the year 2000 versus gold's performance since the year 2000, then the increase in the S&P doesn't seem that attractive, nor frankly does the increase in the gold price.
What should be the time horizon?
Gold is a constant, really. I'm sorry?
What should be the time horizon for anybody like yourself, holding gold as a savings tool? If you look at the chart of gold, for example, here we have right after the gold price adjusted or fell after 2012, there was a period of 9 years when gold was flat, if not down. If you were holding for only a period of 5 or 6 years during that time, you would have been very frustrated with your savings, not at least even beating inflation. And so if you had held a time horizon for 20 or 30 years, then yeah, you'd be laughing to the bank. So the holding period really is important here.
With me, David, it isn't theoretical, it's actual.
Markets can hit record highs while your purchasing power quietly disappears in the background. As Rick Rule points out here, measuring wealth only in currency terms hides what your savings actually buy over decades. The overlooked number is gold spending nearly 9 years moving sideways while real-world asset affordability shifted underneath it. The uncomfortable question isn't whether gold rises faster, it's whether your savings survive long enough to matter. Next, Rick Rule exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
I did hold. Well, I did. I won't say I held gold during that time. I bought gold continually during that time. The last time I sold gold was in 2009, and I didn't sell gold in 2009 as a consequence of the fact that I thought the price was going down. I bought it because I owned it as liquidity, and there were other asset classes that were cheaper. Occasionally, seldom, hopefully, one dips into one's savings to acquire assets that will increase their material standard of living. After the equities market collapse of 2008 and the credit market collapse of 2008, in 2009, there were a variety of financial assets that were on sale at such ridiculously cheap prices that they caused me to liquidate a bunch of my gold to buy, albeit temporarily, asset classes that were cheaper. For me, savings are just exactly that. I'm not trying to make money on my savings. I'm trying to maintain the purchasing power of my savings. I make money investing, which is differently than saving. I make money investing in high quality businesses or speculating.
Mm.
in businesses that I believe might become high quality business, or investing in private businesses like Rural Media, the Rural Classroom, Sprott in the old days. But I save. I maintain my purchasing power in gold unless we have another 2008 style psychotic break in the market. I imagine personally, David, that the sell decision with regards to my bullion will be made by my estate, not by me.
Are you adding more to your savings now that gold has fallen to
I
$4,000?
I am. I'm a systematic saver in gold, and I'm not particularly price sensitive. The only thing that causes me to sell my gold are opportunities that I find dramatically more compelling.
The biggest investing mistake is treating savings and speculation as if they serve the same job. According to Rick Rule, 2009 mattered not because gold failed, but because panic temporarily made other assets absurdly cheap. That distinction cuts against the retail obsession with always maximizing returns. For long-term savers, liquidity is ammunition, not performance, and most portfolios collapse because owners confuse optionality with conviction. Next, Rick Rule reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
When do you, what is your criteria for adding to your gold holdings? You're not price sensitive, so
Added liquidity.
oh,
I,
okay.
Whenever a circumstance occurs that adds substantially to my private liquidity, I use part of that money to buy gold. As an example, in January of this year, you will recall my saying to you that as a consequence of a hyperbolic up move in silver, I sold 80% of my physical silver. That was a
Yes.
speculation. I used 25% of the proceeds to add to my savings, which is to say, I bought, well, with most of it, I bought physical gold. I also added some very, very, very short term treasuries. Uh, I think I'll make a reasonable sum of money on next month's Natural Resources Investment Symposium.
Well,
Uh, a, a substantial amount of the money that's left over after I pay all expenses, I will use to buy physical gold.
I wonder what the sentiment is going to be like at your symposium, by the way. The real symposium is coming up. It's in early July. Let's talk about that. And let's talk about that with this as a backdrop. This is something called the Gold Miners Bullish Percent Index. It was just brought to my attention this week. Very interesting index. And right now you can see it's at a multi-year low. Now, this obviously tracks price, but it has fallen very, very much. Basically, it's fallen a lot more than the price has fallen. If you take a look at it from a percentage change basis, the GDX peaked around the same time gold peaked earlier this year. It's fallen about 37%.
When sentiment collapses faster than price, smart money starts asking whether fear has become the asset. What Rick Rule is highlighting is not blind accumulation, but a transfer mechanism. Speculative gains feeding permanent reserves. A 37% minor drawdown, while broader conviction breaks often signals emotional liquidation before fundamental deterioration. Investors watching headlines miss that institutional capital usually reallocates during exhaustion, not euphoria. Next, Rick Rule walks through the exact timeline when institutional money shifted from bonds to commodities, and why retail is always 18 months behind.
Which is significant, but this has gone down from basically 0 to negative 100, so the lowest it can be if this were a scale. Now, with such bearishness in the market, I wonder what the theme is for this symposium is going to be this year. Do you expect your speakers to be a little bit despondent with the mood, or do you expect the narrative to shift now to lower valuations being a better buying opportunity?
David, I think you need to understand the intellectual complexion of my crowd and the history of the conference. You asking my attendees how they feel like gold is sort of like going into an evangelical church in the American South. and asking the choir if they believe in God. Um,
Okay.
the
Fair
attendees,
enough.
the attendees at my conference for the last few years have had singularly good experience, and I suspect that the job on the dais will be to tamper as opposed to create enthusiasm for both precious metals and natural resource assets. Uh, Two, the discussion that you and I just had about the fact that I consider the market to be a facility as opposed to a subject is something that we've taught for a very long time. And many of the attendees at the conference, the veteran members of the conference, will ascribe to the belief that money is made on the delta between price and value. And to the extent that the price of an asset class or the price of a company falls relative to its value, that's a good thing, not a bad thing. So I would expect that the mood at my conference will be informed ebullience.
Well, the price of the company may have fallen, the value may have stayed high.
The market's darkest mood often appears right before investors rediscover the difference between price and value. Rick Rule's argument suggests that falling prices are not automatically evidence of broken fundamentals. They are often the mechanism that creates future returns. The overlooked signal here is sentiment reaching extremes while underlying asset quality remains largely unchanged. Retail tends to interpret pain as information, while disciplined capital treats it as inventory. Next, Rick Rule unravels why their public narrative about supply requires three contradictions to work.
The intrinsic value, that is. However, the price of a miner does move on the back of gold. And so let's go back to gold for just a minute now. The gold price now sitting at $4,200, peaked around $5,500 when I saw you in Vancouver live earlier this year, late January. Now, that is an extraordinary move in such a short period of time, just a few months. But extraordinarily, it's moved up a lot in the last year as well. Gold is repeating what looks to be like 2011 all over again. Is the worry or the concern by some gold analysts in the space that I've talked to in the last month? Let me just pull up this chart and get your take on that, whether or not you agree or disagree. But the last two secular bull markets that gold has experienced, meaning the late 70s all the way to 1980, and then from the early 2000s all the way to 2011, gold peaked with a similar pattern to exactly what the price is doing now. A double top, correction, and then capitulation. Can you comment on this price movement?
Yeah, with the caveat that my own life is driven fundamentally as opposed to technically.
Mm-hmm.
I would suggest that the recent softness in the gold price has to do with three factors. The most important of which is higher U.S. nominal interest rates. Higher interest rates increase the attractiveness of the U.S. dollar and are tough on the prices of U.S. dollar denominated assets, with the possible exception temporarily, of course, of SpaceX.
Yes.
They also, I would suggest, correlate reasonably well with fears of a recessionary or a deflationary recession.
Public narratives blame charts, but institutional positioning usually follows rates and liquidity conditions first. This is where Rick Rule's thesis shifts from technical pattern recognition into macro cause and effect. Gold falling after a sharp rise does not automatically signal the end of a cycle. If the move is being driven by interest rate expectations rather than structural demand destruction. Portfolio damage happens when investors mistake volatility for resolution. Next, Rick Rule exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
And I think that people are concerned about the possibility of a credit collapse and a recessionary circumstance derailing inflation. I think that most of those fears are misguided. I can't tell you where the gold price will go in the near term. Nobody can, although many
Mm-hmm.
people will try.
Mm-hmm.
But I can tell you that the period that we are going through currently reminds me personally of no circumstance as much as 2000, as pardon me, 1975. And let me take some of your younger listeners through that period. The period 1970 to 1975 was characterized by an increasing fear of inflation in the population and an increase in the gold price from an admittedly price controlled $35 an ounce to a high, if my memory serves me well, of about $200 an ounce. The political fears around inflation caused the US Congress to do something fairly unusual. They decided to do something about it, and they allowed interest rates to rise. And that increase in interest rates cratered the price of gold from about 200 to about 100. It cratered some other things too. The US bond market, the US equities market, durable goods sales, new home construction.
Yes.
Uh, and after a fairly brief period of time, Congress and the American political class, in fact, the voting class lost its nerve and abandoned any pretense in defending the sanctity of the US dollar. When interest rates were forced down, it became clear to savers and investors around the world, not just in the United States, that political expediency was more important than the sanctity of the dollar. And after that happened, after the interest rates were engineered down, the gold price exploded from a low of about 100 US dollars an ounce to a high of about $850 an ounce.
History rarely repeats cleanly, but policy incentives repeat with uncomfortable consistency. As Rick Rule points out here, the 1975 comparison matters because rising rates initially looked like a victory over inflation before political tolerance disappeared. The detail investors forget is that assets collapsed before monetary discipline did. Savers who assume policy will remain painful long enough to restore purchasing power, maybe underestimating political reality. Next, Rick Rule reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
It took two things: very high real gold prices, and then a tripling of the U.S. interest rate under Volcker to finally break the price of gold in 1981. Gold then had to compete with a U.S. Treasury selling at 15. We're a long way from there. By the way, David, I am not suggesting that anybody have 100% of their net worth in gold or SpaceX or anything else. The future is a set of probabilities. There's no certainty whatsoever. But I would suggest that for the American investing public, at least, I can't comment on the Canadians, that gold, the market share of gold and gold-related securities relative to other savings and investment asset classes is 0.5%, down from a 4-decade mean of 2%.
Everyone talks about diversification until the assets they ignored become scarce. According to Rick Rule, gold's share of investment allocation sitting near 0.5% matters more than price because positioning tells you what people believe, not what assets are worth. The hidden tension is that broad participation remains historically low despite years of macro instability. Protecting wealth is usually unpopular, right before it becomes urgent.